Just to recap, the Reserve Bank has announced that interest rates are rising by 75 basis points, which will take effect tomorrow. You should be receiving those letters from your banks at around midnight. That's what they tend to do, send them off to you to tell you you have to pay more money for servicing your loan. Well, to unpack the latest announcement, I'm joined by Goolam Ballim. He's the Chief Economist at Standard Bank, and of course joined as well by Nicky Weimer. She's Chief Economist at Nedbank. Nicky, let me perhaps start with you. 75 basis points. We know the market was thinking anything between 50 and 75. Is 75 basis points overdone, or you think it's just right?
Well, we expected 75, so I would have to say we think it's just right. But no, the reality is that I think there are just so many uncertainties. Some things are starting to move in the right direction. We're seeing oil prices ease. We're seeing food prices ease. The governor himself referred to that. Generally, we are expecting inflation in South Africa to start moderating. But I think the point that they're making is that outlook, there is a tremendous amount of uncertainty attached to those forecasts. There are some really unpredictable elements to it. And, you know, the big ones he referred to, the fact is the war in Ukraine continues to rage on. It seems to be intensifying now with Russia going to a general draft and bringing more soldiers to Ukraine, threatening again, nuclear escalation. Europe's a massive energy crisis that could have certain consequences also for commodity prices. And at the same time, locally, of course, we also have the uncertainty of the rand. We know that the US Federal Reserve remains committed to defeat inflation. They recognize that they need to bring demand and supply into better balance, as they put it, which is just another way of saying they're going to suppress demand. They're going to bring about slower growth in order to bring about lower levels of inflation. So that is going to put pressure on the rand, and the rand over time can add to what is already significant cost pressure, and you can see further pass through. And then we're seeing higher wage demands, and we're seeing that companies are trying to recoup some of the strain they took over the past 12 months as a result of higher prices. And I think that's what's sort of weighing on the Reserve Bank's thinking, and in that context, they decided to, err on the side of caution and go with a 75.
Goolam, are debt holders in South Africa being punished because of external factors, or does core inflation suggest that there is reason for the Reserve Bank to act in the way that it has done?
The Reserve Bank would appear to be rational. 75 basis points, no doubt, feels bludgeoning. But if one considers that 2 of the 5 Monetary Policy Committee members leaned towards 100 basis points increase, then it signals that this decision seemed to have been on a knife edge. And so 75 basis points, while still punitive, combined with the cumulative rate hikes this far, would signal consistency in terms of the Reserve Bank's fears. Now, in line with Nicky's remarks, and I'm probably just embellishing here, the summary statement that encapsulates the Reserve Bank's posture is when the governor said the balance of risks remain to the upside. Of course, he then listed oil as a potential risk, public sector wages also, and overarchingly, inflation expectations. So with the idea that the Reserve Bank has always maintained an orthodox, typically central bank posture, with the balance of risks still in the SABC assessment facing to the upside, 75 basis points was therefore entirely rational and largely predicted by the market, also as Nicky has suggested.
So, Nicky, when it comes to the consumer, I suppose this is a double-edged sword. On the one hand, this is great for pensioners and people who save money. And then, of course, it's negative for people who have debt. Just speak to that a little bit for us.
Yeah, I think the key thing there is that, if we talk, obviously, over time, those that are net borrowers, in other words, they have debt, whether it be vehicle finance or car debt or mortgages, over time, the hikes in interest rates will accumulate and the impact will start to affect the demand for credit. The Reserve Bank actually mentioned in that statement that they believe that the level of interest rates are still supportive of continued credit demand. I think it's starting to bite. We would maybe not entirely agree with that. We think that it is slowly and surely coming through in demand for certain credit products. It's not universal yet. Credit is still fairly robust in the South African economy. But of course, we know the lags here is long, and it's probably going to catch us next year rather than this year from that side. The most vulnerable group here are really the spenders, are the people that don't have a lot of debt, is your lower household income groups, and they are the ones that really need inflation to be under control. Inflation does enormous damage to their purchasing power. And I think that's why those that complain about interest rates going up are not really seeing the big picture here. The bigger damage to the vast majority of South Africa's population, which really falls in your lower income to lower middle income groups, inflation is much more damaging to them than rising interest rates. And so I think from that perspective, the Reserve Bank has it right. You have to bring inflation back down. Goolam made the good point of inflation expectations haven't risen. That's that vicious cycle where inflation starts to feed on itself, becomes entrenched, and that is exceptionally damaging to the poor. And then, of course, higher interest rates, as you rightly mentioned, is better for those who are savers. Over time, the impact is going to be to slow the economy. It is going to have that effect. But it doesn't necessarily have to trigger a recession. I think what is feared globally is that this is not an exact science. You don't know exactly where that level of interest rates are that will tip the economy into recession. And so it's a risk globally, and it also remains a risk locally. But I think the governor is quite right saying, we've kind of gone back to pre-pandemic interest rates level. So we're not quite at that point that we need to panic about recession as it speaks.
Yeah. Goolam, just touching on what Nicky was saying there about the possibility of recession or possibly not. I mean, here in South Africa, we're having to contend with stage 5 load shedding, and we're told that we're advised that could stay at this kind of level for quite some time. And we've had the president in the country for a couple of days, and we're not hearing about immediate interventions. Yes, we've heard about the signing of IPP agreements today that will only really bring energy to the fore in the next 2 years, which doesn't help with our current situation. So when we look at that particular issue, as well as the fact that at the end of the day, the South African economy is not really gaining traction over and above the load shedding, what does that do to the outlook? And are you in agreement with what the Reserve Bank was saying about the growth forecast?
Consensus has South Africa's GDP for this year slightly south of 2%. Of course, we had gone into the year generally with expectations of between 2 and 2.5%, but that optimism, if you can call 2 to 2.5% glistening, has been clipped by, as you say, energy rationing. Over the last 3 years, we estimate that the power shortfall has clipped growth by approximately 1 percentage point per year. This year, given that the power rationing, the power shortfall will eclipse anything we've seen over the last 15 or so years, it would not be fetched to assert that we will see the GDP outlook clipped, as I've suggested, by maybe 1.2, maybe even 1.3 of a percentage point. Obviously, the higher levels of inflation, higher interest rates commensurately will also increasingly show traction in restraining spending, even though that's likely to be a more dominant theme in 2023. But in essence, I think what we can say is that South Africa seems stuck in a 1.5% to 2% GDP growth path. And of course, that's insignificant relative to other more potent and thrustful EMs. And also this level of growth is not adequate to deal with the socioeconomic hemorrhaging that South Africa is plagued by. So quite simply, it is going to be a strain over the forthcoming quarters in terms of economic health. And the Reserve Bank would say that its tightening of monetary policy is unavoidable it will concede that it will induce pain, but that pain is near term and unavoidable, so as to foster a more medium-term constructive outlook, and in that is the essence of central banking.
Now, Nicky, interestingly, the governor, Lesotho Kganyago, was saying that he feels, or that the MPC feels, that private investment and consumer spending have been largely supportive of the economy, even though we're not growing at a massive pace. But he expects that consumers are going to be coming less to the party come 2023. How do you see those dynamics? And when we look at the confidence indexes, business and consumer confidence, it doesn't really support a view that people are going to be spending and investing like crazy going forward.
Yeah, no, I mean, I think what he's referring to is if you look at the first half of this year and even in the second quarter, where the economy was again subjected to a whole bunch of shocks, one being the floods in KwaZulu-Natal, and then again, the one constant in our lives, right, load shedding. So that was again present. At the same time, we had that strict lockdown in China. We're big exporters of commodities. That weighed on our export performance, and it was visible in our export performance. And so if we look at the second quarter numbers, the drag really came from the production side of the economy. It was mining, manufacturing, agriculture that struggled, and that translated into a poor export performance. Whereas if we look at the domestic expenditure side, everything slowed down. Consumer spending slowed down. Fixed investment slowed down in the second quarter, but it remained positive. And I think that is what he's essentially referring to. And then going forward, they're expecting fixed investment to remain relatively robust, as I understand, if I read the statement correctly. But they do expect that consumer spending will start to slow. And that's really just reflecting the impact of inflation. Inflation, of course, is consistently eroding disposable income and purchasing power, putting strain on the consumer. And for those that have debt, then, of course, as interest rates rise, that means it costs them a lot more to service their debt, and they've got less money available at the end of the day for spending. As Goolam said, it slows down spending. That is going to be the outcome. But what I think they're essentially saying is that they don't think it's going to result in consumer spending contracting, but definitely weakening. And then fixed investment, they say, is going to stay strong. And you're right, confidence indicators, the fact that we're experiencing stage 5 load shedding, that all seems a little bit counterintuitive. How can fixed investment remain positive in those sorts of circumstances? And I have to say, I do think it's going to be probably weaker than maybe the Reserve Bank is counting on. But what we do know is that we're coming in fixed investment off such a ridiculously low base that it doesn't take a lot to get a positive number. That's the first point.
Nicky,
and then secondly, we know there are all these projects on the go, especially renewable energy projects. So it's more pockets of activity rather than a broad-based recovery in fixed investment.
All right, Nicky, let's pause there. We're going to go for a quick break and we'll spend another 10 minutes or so speaking with the analysts.